Every single day, long before you check your phone, before you eat breakfast, before you step outside your home, oil corporations have already influenced your life, not loudly, not directly, and almost never in ways that feel obvious. Most people think oil only matters when fuel prices rise, when they see numbers change at a gas station, when headlines talk about shortages or conflicts. But oil's real power is far quieter than that. It lives inside food prices, housing costs, inflation, global politics, and even the design of the cities you live in. It shapes decisions you never vote on through systems you were born into. Today, we're exposing how oil corporations shape your daily life, not through conspiracy theories, but through documented structures, reported data, and incentives that most people never see. And by the end of this video, you may realize something uncomfortable. Oil doesn't just fuel the world, it organizes it. To understand how oil gained this level of influence, we need to start with a simple fact that rarely gets enough attention. Modern civilization was built around oil. According to widely reported global energy data, fossil fuels still provide more than 80% of the world's primary energy. Despite decades of discussion about renewables, oil and gas remain the backbone of transportation, manufacturing, agriculture, and global trade. Entire economies depend on it. National budgets rely on it, stock markets react to it. Governments negotiate around it. The global oil and gas industry generates trillions of dollars each year. But money alone does not explain influence. The real question is this: how did oil corporations become so deeply embedded into everyday life that even people who never invest in energy stocks, never work in the industry, and rarely think about fuel prices still feel their impact every single day? The answer lies in systems, not scandals. When oil prices rise, most people notice it at the pump. But fuel is only the most visible part of oil's reach. Oil is a foundational input into modern life. It affects almost everything you buy, even if oil itself never appears on the receipt. Agriculture depends on oil for machinery, irrigation systems, and fertilizers, many of which are petroleum-based. Food travels thousands of miles before it reaches supermarkets, powered by fuel at every stage. Clothing relies heavily on synthetic fibers like polyester, nylon, and acrylic, all derived from petrochemicals. Packaging, from plastic wraps to containers, comes from oil. Construction depends on fuel-powered equipment and petroleum-based materials. Even pharmaceuticals and household products use oil-derived compounds. Reported economic studies consistently show that when oil prices rise, inflation follows, not immediately, but with a delay. This delay is important. It hides the cause. By the time food prices rise or rent becomes more expensive, the oil price decision that triggered it may have happened months earlier, in a different country, through a market most people never see. This is one of oil's greatest strengths. Its influence is indirect, delayed, and difficult to trace. And systems that are hard to trace are hard to challenge. Many people believe oil prices move simply because of supply and demand. More oil means lower prices. Less oil means higher prices. But oil is not just a physical commodity. It is one of the most heavily traded financial instruments in the world. Prices are influenced not only by how much oil exists, but by expectations, futures markets, investor sentiment, and geopolitical risk. According to financial and historical records, oil prices have often moved sharply even before actual shortages occurred. Markets react to fear, anticipation, and uncertainty, sometimes more than reality itself. In practical terms, this means oil prices can rise even when supply remains stable, simply because traders expect disruption. Volatility becomes profitable. Oil corporations and large financial players do not earn money only by selling oil. They can also benefit from price swings, uncertainty, and speculation. Stable prices benefit consumers. Unstable prices reward financial power. And oil markets are built around uncertainty. At this point, a reasonable question emerges. If oil affects inflation, food prices, and economic stability across the world, why don't governments regulate it more aggressively? Why not impose stricter price controls, accelerate alternatives, or reduce dependency faster? The answer is not hidden meetings or secret deals. The answer is dependency. Modern infrastructure was designed for oil. Highways assume fuel-powered vehicles. Global shipping depends on oil-powered fleets. Aviation has no large-scale alternative yet. Industrial agriculture relies on petroleum-based inputs. Suburban cities were built around long commutes. This creates what economists call path dependency. Once a system is built around a resource, changing it becomes slow, expensive, and politically risky. Governments rely on oil for employment, tax revenue, economic stability, and national security. Sudden disruptions can trigger inflation, social unrest, or political backlash. This creates a structural imbalance. Oil corporations do not need to control governments. They only need governments to fear instability. And that fear shapes policy more than ideology ever could. According to publicly available records, energy companies spend hundreds of millions of dollars each year on lobbying across major economies, including the United States, the United Kingdom, and Europe. But this influence is often misunderstood. It is rarely about stopping change completely. Instead, it focuses on shaping timelines, delaying regulations, extending transition periods, negotiating exemptions, protecting existing investments. Even as governments announce ambitious climate targets, reported data shows that fossil fuel subsidies worldwide still amount to hundreds of billions of dollars annually. This is not always because leaders deny environmental risks. It is because rapid transitions threaten economic stability in systems built around oil. Oil corporations operate in this space, where economic fear, political risk, and long-term planning collide. Oil's influence extends beyond economics and policy. It shapes global geopolitics. Access to oil has historically influenced alliances, conflicts, and foreign policy decisions. Shipping lanes, pipelines, and production regions are treated as strategic assets. Energy security is often framed as national security. Countries that control oil resources gain leverage. Countries that depend on imports manage vulnerability. This reality shapes military spending, diplomatic priorities, and international negotiations, even when oil is not mentioned publicly. For ordinary people, this shows up as higher defense budgets, international tensions, and global instability that feels disconnected from daily life. But oil sits quietly in the background of many of these decisions. One of the most common questions people ask is why the transition to renewable energy feels slower than promised. The answer is not a lack of technology alone. It is asset protection. Oil infrastructure represents trillions of dollars in existing investments, refineries, pipelines, drilling equipment, shipping fleets, and supporting industries. Rapid change risks turning those assets into losses. So transitions become managed rather than accelerated. Gradual change protects balance sheets, pension funds, and national revenues. This does not mean renewable energy is impossible. It means transitions are shaped by economic realities, not just scientific urgency. And oil corporations understand this better than anyone. There is also a psychological dimension to oil's power that rarely gets discussed. Normalization. Because oil has shaped modern life for over a century, its influence feels natural. People adapt to price increases. They accept inflation as abstract. They blame the economy without questioning systems. Normalization reduces resistance. Systems that feel normal rarely get challenged. This psychological effect is powerful. When something becomes invisible, it becomes untouchable. Oil corporations do not rule the world, but they shape the systems the world depends on. That distinction matters. Power does not always look like control. Sometimes it looks like inevitability. Oil did not dominate because of secrecy or force. It dominated because it became essential, quietly, gradually, and efficiently. Understanding this is not about blame, it is about awareness. Because awareness changes how societies respond. The future question is not whether oil's influence will decline. Most experts agree that, over time, it will. The real question is who controls the pace of that decline, and who bears the cost. Will transitions be fast or slow? Who absorbs economic shocks? Who protects existing wealth? Who pays higher prices? These decisions are being made now, often far from public attention, and they will shape daily life for decades. Oil corporations shaped the modern world, not through a single moment, not through a single decision, but through systems that became too important to fail. And once something becomes too important to fail, it becomes very hard to change. So here's the question that matters. Should governments force faster energy transitions, even if it raises costs in the short term, or should markets decide the timeline? That debate will define the next era. If you want calm, evidence-based global exposes that explain the systems behind everyday life, subscribe. And press the bell icon for timely notifications. Thanks for watching.